Let me start with a simple question that a lot of people are quietly asking right now. Is it still safe to invest going into 2026, or did we already miss the opportunity? Because when you look around, nothing feels calm, prices are high, headlines feel confusing, and many people feel like the economy doesn't match what the markets are doing. But here's the truth most people don't hear clearly. Markets don't move based on feelings, they move based on money flow. And right now, money is getting cheaper, not more expensive. That single fact changes everything. What I want to do in this video is walk you through how the system actually works. In plain English, no hype, no fear, just logic. Because once you understand what the Federal Reserve is doing right now, investing in 2026 starts to make a lot more sense. Let's talk about the most important word in investing that almost nobody explains properly: liquidity. Liquidity simply means how much money is available in the financial system and how easy it is to borrow, lend, and move that money around. When liquidity is tight, everything feels heavy. Loans are expensive, spending slows down, markets struggle. But when liquidity increases, the opposite happens. Borrowing gets easier, money moves faster, and asset prices tend to rise. Think of it like water in a river. When the water level rises, boats float higher. When the water level drops, everything scrapes the bottom. Right now, that water level is rising again. And this affects far more than just Wall Street traders. It affects your retirement account, your savings, your investments, even the long-term value of cash sitting in your bank account. Here's where people get confused. They look at their personal finances and say, things feel tight, costs are high, how can markets keep going up? But markets don't respond to emotions, they respond to access to money. When money becomes easier to access, it doesn't just sit still, it looks for a return. It flows into stocks, it flows into ETFs, it flows into real assets, it flows into gold, silver, and anything seen as a store of value. That's why markets can rise, even when the economy doesn't feel great. Now let's talk about the Federal Reserve, because this is where everything connects. The Fed controls short-term interest rates. When rates are high, borrowing slows. When rates are cut, borrowing becomes cheaper. Cheaper money changes behavior across the entire system. Companies refinance debt, investors take more risk, cash earns less interest so people move it elsewhere. Future profits become more valuable when discounted at lower rates. This is why rate cycles matter so much. And here's the key point for 2026. We are no longer in a tightening phase. We are moving into an easing phase. That matters. But there's something even more important happening that most people miss. The Federal Reserve has quietly started expanding its balance sheet again. They use technical language for it. They say it's for reserve management or market stability. But functionally, it means more money entering the system. And markets don't care what it's called, they care what it does. More money in the system equals more liquidity. More liquidity supports higher asset prices. This isn't theory. This is how the system has worked for decades. Some people say this won't last, that the Fed will stop quickly. But here's the reality. The system today requires liquidity. The government runs large deficits. Banks rely on reserves. Markets depend on stable funding. Once liquidity starts flowing, it's very hard to shut it off without something breaking somewhere else. That's why liquidity cycles usually last longer than people expect. And this brings us to an important question. What happens to the value of money itself? When interest rates fall and the money supply grows, the value of cash changes. Specifically, the purchasing power of the dollar tends to weaken over time. This doesn't mean the dollar collapses overnight. It means each dollar slowly buys a little less, and that has major implications for investing. A weaker dollar often supports higher prices for US stocks, commodities, and precious metals. Take gold and silver as an example. When people say gold is going up, What's really happening is that it takes more dollars to buy the same ounce. The metal didn't change, the measuring stick did. That's why precious metals tend to perform well during periods of monetary easing. This isn't ideology, it's math. Now, here's something else investors need to understand. There is an unspoken backstop in the financial system. People call it the Fed put. It doesn't mean markets can't fall. It means severe stress tends to trigger a response. We've seen this again and again. When markets fall sharply, the damage doesn't stay in one place. It spreads into credit markets, jobs, housing, and consumer confidence. At some point, the cost of doing nothing becomes greater than the cost of intervention. That's when the Fed steps in with rate cuts, liquidity programs, and emergency support. This is why major crashes are often followed by aggressive policy responses. And today, the system is more sensitive to liquidity than ever before. Debt levels are higher. Markets are more interconnected. Stress spreads faster. That means policy responses tend to be faster too. Now let's talk about 2026 specifically. We're entering a period where monetary conditions are becoming more supportive, not restrictive. That doesn't mean markets go straight up. You will see pullbacks. You will see volatility. You will see scary headlines. But in liquidity-rich environments, pullbacks tend to get bought. So what does this mean for someone trying to make smart decisions with their money? Here's the practical approach. First, staying invested matters. Sitting entirely in cash during an easing cycle means quietly losing purchasing power over time. Second, consistency matters more than timing. Trying to wait for the perfect moment often results in missing long stretches of growth. Third, diversification matters. Stocks, real assets, and some exposure to hard assets can help balance risk. Fourth, cash still has a role. Emergency savings matter. Flexibility matters. You don't invest money you can't afford to leave invested. And finally, emotions matter more than predictions. Fear makes people sell low. Excitement makes people chase highs. Understanding the environment helps you stay calm. The setup going into 2026 doesn't remove risk. Risk always exists, but the winds are not working against you the way they do during tight money periods. The system is built to function on liquidity, and liquidity is increasing. So the real question becomes this: do you want to understand how the system works and participate carefully? Or do you want to sit on the sidelines while inflation slowly erodes your buying power? You don't need to be aggressive. You don't need to be reckless. You just need to avoid fighting the environment. Because when money gets cheaper, assets tend to benefit. And understanding that puts you ahead of most people. If this explanation helped you see the bigger picture more clearly, make sure to stay informed and keep learning. Smart investing isn't about guessing. It's about understanding how the system actually works. You've got this.